Well, prepare for another wild ride in the stock market today. Right after the opening bell, the Dow jumped back into positive territory, climbing more than 100 points in the first 30 seconds of trading. It's now up more than 300 points. Now, this comes after yesterday's loss of more than 870 points after President Trump threatened new tariffs. It was Wall Street's worst day since October. CBS News business analyst Jill Schlesinger joining us live now to dig into the concerns on Wall Street. Good morning, Jill. I know the president, again, has threatened to hit 8 European countries with new tariffs as he seeks control of Greenland. We saw those markets plunge yesterday. They're back up now a bit. But could these threats against Europe make for a volatile market long term?
Well, I don't know. I don't know what our attention span is these days, so I'm not sure what long term is. But until we understand whether or not these tariffs are going to be imposed, I think there's going to be uncertainty that kind of sits on top of these markets. Now, it wasn't just stocks. So when you feel uncertain, if you're a big investor, what you'll often look at is say, hey, you know what? Let me sell some stocks. They also sold the U.S. dollar, U.S. government bonds, and they bought gold. Gold touched a new all-time high. So when you see uncertainty like this, it will stick around. We saw it last year, so we shouldn't be so surprised when those Liberation Day tariffs were introduced. But so everybody out there is watching and wanting to know what to do. You're a long-term investor. You're going to do a whole lot of nothing.
As you just alluded to, stocks have tended to be up and down when President Trump threatens tariffs on U.S. trading partners. Then they get back on track when he backs off. So do you anticipate a similar pattern here, or do you think this might be a little bit different?
This could be a little different, and the only reason I say that, because you always get into trouble when you say this time is different, but there is some interesting behind-the-scenes negotiation going on. You know, we just have this big conference in Davos, right, the World Economic Forum, and you had the Canadian Prime Minister give a speech that's really catching fire around the world, and the speech was essentially saying, without explicitly pointing a finger at President Trump, saying there are superpowers who are kind of bullies, and we middle economies, some of these different countries in Europe, Canada, should band together and really fight back against it. So, you know, what I think everyone is watching on Wall Street is, are we going to get into a different type of trade battle where some of these countries, instead of going it alone, band together and try to push back against President Trump? And so that's what the sort of the ear to the ground on trading desks is right now.
Oh, gosh. Well, that would be interesting in terms of how that would affect the markets. Now, I know in terms of advice for investors, you said long-term investors, you're going to do a whole lot of nothing. But do you have any other advice for maybe nervous investors right now?
You know, if you do need money within the next 12 months, I always suggest that it should not be in anything risky. So maybe you're like, uh-oh, I have a tuition bill to pay, and by mistake that money is in the stock market. It shouldn't be. Any money that you know you're going to need within the next 12 months should be in a cash or a cash equivalent, right? A cash, a money market, a high yield savings, a CD. But for most people who are long-term investors, you're looking at your retirement account, use last year as this model. Last year we came into the year, stocks went up. The Liberation Day tariffs were announced. They plunged by 19–20%. Then from that moment in April through the end of the year, stocks staged an impressive comeback. They were up 37% from the low level in April. Finished the year, the S&P 500 up 16.5%. Use that as your model. Try not to make any sudden moves.
All right, good tips as always. Jill, thank you so much. We appreciate you joining us and giving us some more insight.